That's the thing, Neelkanth, because the observation has been across, markets and, people we've been speaking with, that it doesn't deviate a whole lot from the interim budget. But at the same time, it's kind of promised, or rather delivered what the anticipation was. It's done decent enough bit for consumption, higher capex, lower fiscal deficit target. All of these are clear positives. Other than the capital markets taxes, there's nothing outright that you can pinpoint that wasn't delivered that you did hope and pray for.
Yeah, even on the capital gains taxes, frankly, if you parse through all the comments made by senior policymakers, I mean, the people in the finance ministry, RBI, SEBI, I think the concern on froth in the stock markets, and also I think the desire to reduce distortions or remove distortions in the plumbing of savings, where the savings are flowing because of the differentials in tax rates. I think so it was, I think, reasonably clear if you were looking at and reading the tea leaves that taxes would go up. Frankly, people were apprehensive that this number could actually be 15% or 20%. So the fact that it is from 10% to 12.5% appears quite marginal. So instead of pushing equities taxation to where fixed income was, they've actually brought down the taxes to the taxes on most of other asset classes to where closer to where equities were. So frankly, even that is not a big negative. I think going forward, the message that frankly I've been giving the last 10 years is that, look, the budget is about presentation of the ins and outs of the government's consolidated fund, which is how much revenue it is getting and where it is spending it. And there is going to be increasingly even less to talk about in the budget. It is, as you see, predictability. What was remarkable about this budget for me was how predictable things were, given that there was supposed to be a 70 basis points consolidation, and the provisional deficit in FY24 turned out to be 5.6, not 5.8, which was then the revised numbers. So it was reasonable to expect that there would be another 20 basis points in the revised numbers for FY25. Similarly, the fact that the gains from RBI dividend were one-off in nature, that they would be spent in a way which was one-off, so it was used to bring down the fiscal deficit. It was also used for capex loans to states. I think those make it very clear that the government's behavior will be predictable, and that's actually extremely important for the private sector to get the confidence and start investing again.
I want to pick up on the point about consumption, because some of the critiques, Neelkanth, would say that allocations at a household level are not enough to really spur the kind of consumption that one anticipated, and especially to try and prop up the rural end of the economy.
Every doctor, when they are delivering a medicine, also looks at side effects. So the first constraint for the government, and we should keep that in mind, because of the pandemic, the debt to GDP is at a very high level. So 80% debt to GDP at a general government level is very risky. I mean, in fact, if there was to be another, say, some global crisis, and we may actually start getting into a debt trap. So I think the cognizance of the fact that our debt to GDP is very high has to be there. In that context, you need to keep bringing down your fiscal deficit. So that's again then becomes a binding constraint. You cannot bring it down too fast, because if you do that, you slow down the GDP, and then your debt to GDP starts to go up. Now, therefore, every rupee that you spend has to have a multiplier. So if you hand over money to people, they will spend it, but after that, what? However, if you spend it on infrastructure, as you rightly said, the construction of the infrastructure creates jobs and demand and all that, but then the use of that infrastructure then drives productivity growth. And therefore, as the government in this period, and this period is going to last several years, needs to be extremely responsible on the multiplier effect of the spending it does. In that context, I think the space for doing significant amount of consumption stimulus is automatically constrained. the government then, but it has, there's been the one change I noticed was a nod to job creation. I think the acknowledgement that there is slack in the labor market, the economy is still 1.5 years behind where it should have been if the pandemic had not happened, means that there are about 1.5 crore people, 10-15 million people who are additional, and a surplus and looking for jobs. And how do we incentivize that? So I think the fiscal allocation there, about 100 billion rupees, 10,000 crores, is not very substantial, but the intent is clear as to that we need to start creating jobs. So I think direct stimulus can very quickly become constraining. So state governments, you may have noticed, 10 states of India are now running income transfer schemes, which add up to 1.8 lakh crores, 1.8 trillion rupees, 0.6% of GDP. Now, for the government to launch a scheme which was way bigger than that, I don't think there was enough fiscal space.